A very good evening to all. I, C.S. Ankna Desai, on behalf of the Women's and Young Member Excellence Committee at ICAI, extend warm welcome to all of you to the Sky Symposium series. This series is conducted by the committee to share the technical updates, enhance non-technical skills, and encourage our members to confidently express themselves in public forum. This initiative aims to upskill and inspire our members to step forward and make the most of their abilities. This series is conceptualized by Chairperson of WI-MEC CA Preeti Savlaji, who is also a Chairperson of Sustainability Reporting Standard Board and a Vice Chairperson of Valuation Standard Board for the year 23-24. And Vice Chairman of WI-MEC CA Abhay Chaudhary, who is also a Chairperson of Commercial Laws, Economic Advisories, and NPO Cooperative and Vice Chairman of Accounting Standard Boards. Sky High Symposium is not just about technical updates. It's a platform to cultivate non-technical skills and empower our members to shine confidently on the public stage. Today's session in Sky High Symposium number 69 holds the promise of enlightenment as we explore the subject areas of tax audit and importance of work-life balance for women CA. It's my pleasure to introduce our today's speaker, CA Priya Vora. She is an Associate Director with Khimji Kuvaji and Company, LLP, having 6+ years of experience in the field of auditing and insurance. She specializes in statutory audit of clients from real estate, insurance, and financial service sector. She has successfully completed the certificate course on Ind AS knowledge tool by the accounting standard boards of the ICAI. She has also been a part of various programs organized by Vikasa. She has also been an active speaker on various forums covering topics relating to auditing and accounting. Now, I would request CA Priya Voraji to take the session ahead.
Thank you so much, Jankna. I'll just share my screen so that we can quickly start. Just let me know once my screen is visible. Is my screen visible and I'm audible properly for everyone?
Yes, ma'am.
Okay. So a very good evening to all of y'all. I hope I'll be able to meet the expectations of the webinar being conducted in terms with the expectations set forward by Preeti ma'am and Abhay Chaudhary. I would like to congratulate for having this platform to share a knowledge. So that's where I would be very happy to be a part of this. And thank you. I'll just move forward. So the topic today that we are covering is on tax audit, which will have all the clauses that I would be covering, specifically the important clauses. I assume everybody would have read tax audits or have been doing tax audits in their practical experience. So I may not be touching specifically on the basic nuances of it, but I will definitely take care of a lot of practical aspects in the tax audit domain. So the background set forward here is Section 144 AB of the Income Tax Act is applicable, which gives a trigger point for applicability to businesses and professions which have sales, turnover, or gross receipts more than 1 crore or 50 lakhs respectively. You have presumptive taxation sections such as 44 AD, ADA, AB, etc. So all those sections will have a taxability or a tax audit applicability from the perspective of 44. From the perspective of presumptive taxation. The due date for filing the tax audit report or the transfer pricing report is ideally 1 month prior to the due date of furnishing the ITR, which is 31st October and 30th November. So that's why our tax audit report furnishing date becomes 30th September and transfer pricing audit becomes 31st October. The major difference, or I would say the major change that has been brought by the Income Tax Department now is basically for bringing a lot of digitized platforms available, and that's why we do all our report filing of tax audit also through a JSON file, which is completely electronic driven. We file it on the portal, and the reason why they have asked for a 1 month prior due date for furnishing the ITR is because a lot of information from the tax audit would be auto pulled by the software and put it in place when the ITR is filed. So that has not yet been effective, but that's the ultimate agenda that they are looking out for. So that's the major reason why we file our tax audit report 1 month before the due date of filing the ITR. A lot of information in the ITR will then get auto-pulled. As of now, for assessments, all these are linked and used, and that's why the assessments have a lot of questions specifically targeted to the information driven from the tax audit report. The tax audit report has to be filed on or before the due date, which is 30th September. If not, you have a penalty under Section 271B, which is lower of 0.5% of the turnover or 1.5 lakhs. There is a interplay between true and fair that we do for an audit in statutory audit, or I would say in terms of any other audit where we have a true and fair opinion. Whereas in tax audit, there is a difference in between true and fair and true and correct. Here, whatever information that you are giving to the authority should not be inaccurate, and it should have a correct information. So that's why the report that we will be issuing will not form true and fair opinion, but it is a true and correct opinion. If there is any inaccurate information provided, you will have a penalty under 271J of 10,000. Now, why tax audit? So like we discussed, that it is basically an verification and inspection of accounts for the taxpayer, so that it is in terms with or in sync with income tax law. The purpose of this was to have an accurate books of accounts being maintained, which will reflect the actual and true income of the taxpayer, and basis that all the allowances, disallowances, claims, whatever charged by the SSE is easily available or readily available to assist the AO for doing its assessments. The major reason, earlier we used to have a manual form being filled and in an Excel template, and then we used to upload it separately in a specific JSON file, or I would say a CSV template. But now that has shifted completely to a digitalized platform. This is the applicability in terms of all the sections mentioned. Just a summary, say you have a business turnover of around 8 crores, but you have cash receipts or payments less than 5%. There is still an exemption available that you need not have an applicability of audit under Section 44AB. That's the proviso that is available. The next is on if you have any turnover which is up to 1 crore, which is less than 1 crore, you are actually exempt. But specifically say you have 6% of profits from digital transactions or 8% of profit from non-digital transactions. If it is more, you are not eligible for a tax audit. But if you have less than this, you are eligible for a tax audit under 44AD, which is a presumptive taxation that we're looking at. For profession, it's the same that we discussed right now. What would be covered under cash receipts or cash payments less than 5%? What is included? These are the payments which are included. So say receipt, you have a trading receipt, which is cash sales, receipt from debtors, everything which is in cash, any cash loan which is received, any sale proceeds from capital asset. Similar way for payments, you have a trading payment, any cash payment, or any purchase of capital assets. Now, for being a tax auditor, for being eligible to be a tax auditor, there are certain conditions that we need to meet. One of those are you definitely need to have a code of ethics in place. You cannot be indebted to the company in which you are being appointed as a tax auditor for more than 10,000 rupees. There should not be any undisputed audit fees, which is under Companies Act specifically, or any other statute. So any undisputed audit fee which is pending and it is not being paid, for those entities, you cannot be appointed as a tax auditor. If you wish to be appointed, you need to first ensure that these undisputed fees have been cleared out. This is in interest and in terms of the ICAI Code of Ethics. The eligibility for appointment of tax auditor is you cannot be an internal auditor for that company. Other than that, you cannot have relatives who have more than 20% interest or voting power in that entity. You cannot be appointed as a tax auditor in those companies. Going forward, there's one specific issue, or I would say one specific clarification that we all keep seeking is whether the tax audit fees can be more than the statutory audit fees. So to this, we have a recent guidance note which has been issued by the institute, but this clarification was already there in the past guidance note as well, where specifically it has been mentioned that the determination of the tax audit fees is purely and clearly on the basis of time allocated by the client, by the audit team on the client specifically, not on the determination of the audit fees which have been agreed on, because statutory audit is a completely different domain and tax audit will be considered as a different domain. It could be that, say, for a tax audit fee for a manufacturing entity would be different than a trading entity because of the work involved, the voluminous data involved in terms of reporting requirements. So it is purely based on the time involved by the auditor. The ceiling on tax audits is 60 per partner. And not to forget, you need to mention UDIN as well as you need to comply with all the documentation requirement, because now it will be subject to quality review board with effect from 24th July. So tax audit forms, I think we are all clear on where to file 3CA, 3CV, and 3CD is something which is applicable to everyone, which is divided into two parts, Part A and Part B. Clause 1 to 8A is nothing but Part A, and Part B is Clause 9 to 44. I'll be touching on specific clauses, not on all, considering we have a very short time, but I would try and cover most important clauses possible. In Part A, I have only one clause covered, which is nothing but Clause 8A. This is only specific for discussion because the specific rates that have been applied or I have been opted by the assessee, there's one specific issue which comes up is those relevant forms, which is 10 IB, ICID, needs to be filed before a specific tenure that is given to you or before filing the ITR. You cannot have this form uploaded. If you have not uploaded this form, you are still not eligible to claim this exemption. You need to file the form on time, on due date. So keep that as a lot of SSCs that I see today face this problem of starting to file the return, and then while opting, they feel, oh, this form is not filled, and then their entire process gets delayed. Also to note here that once any section has been opted for, you cannot withdraw that. And if you withdraw it, you can withdraw it only for 1 year after the year you have opted for it, but then you cannot re-exercise it. So once if you go back, you cannot go to it again. So you can opt it for once itself. The next is Clause 13, which is nothing but ICDS. There are these 5 specific questions asked, and then there's a disclosure requirement for ICDS. I would say this clause has been the most challenging when it was implemented. Now, I think a lot of people have been doing good with it, filing all the details correctly. One specific issue I would like to point on is nothing but Clause D, where you have the adjustments to be disclosed, where ICDS 1 to 10, all the adjustments which are made to the profit and loss for complying in terms of the ICDS, when you need to disclose all these specific amounts in this clause, there's specific issues which arise because nowadays I have seen in 1 or 2 entities plus in some assessments that come up, there are issues where unnecessary information being disclosed here which were not required because those are already been disclosed in some other form or in some other way in the ITR, but have been disclosed here. So there is a difference of what is required to be an adjustment, because these adjustments are nothing but something which is different than what you do. One example I would give you in terms of Income Tax Act depreciation and Companies Act depreciation, which I've usually seen. The income tax depreciation that we calculate is obviously reported in clause 18, and the depreciation amount automatically gets captured. And the book depreciation that is there, we obviously disallow in the income tax ITR that we file. If we specifically mention this in ICDS here, as say ICDS 5, specifically you mention increase in profit because of companies books depreciation, that is Companies Act depreciation, and decrease in profit by this, there's a double disallowance that gets triggered. And then the income tax authorities, because it now gets directly assessed through CPC portal, there is usually a double disallowance given to you because the ITR that is filed has already taken this into cognizance, plus this disallowance gets captured into. Once you file a rectification for this with CPC, CPC will say this is in the domain of the assessing officer. And at some point of time, the assessing officer says this has been directly assessed by the CPC, so you need to go back to the CPC. There'll be to and fro around this section. To our efforts, this gets solved at the later stage, but this is one error, or I would say one specific place where we need to be cognizant of. Only those adjustments which we make under ICDS should be specified under our ITR as ICDS adjustments made in terms of whatever you are doing, so that that can get correlated here and no double disallowance can occur. Going to the disclosure requirements, I have just jotted down simple ICDS-wise disclosure requirements for people to just understand. I'll just quickly brush through this. So in accounting policies, the ICDS is recognizing only assumptions such as going concern, consistency, and accrual, but they are excluding prudence and materiality concept. And obviously, the presentation and the treatment of the transaction is specifically substance over legal form. This is more or less in lines with Ind AS 1, which we use, or say AS 1 that we use, but it is excluding prudence and materiality concepts. So we need to take into cognizance any other material disallowance. If because of being immaterial, it is being ignored by the tax auditor, it has to be ensured that certain adjustments in relation to this needs to be disclosed. If there is any valuation of inventory, it is cost or NRV, whichever, which is in sync with Ind AS 2 and AS 2. In case of dissolution of firm, AOP or BOI, irrespective of the continuance of business, the inventory shall be valued at NRV. The construction contracts, it remains the same. The contract revenue or contract cost of the construction contracts are recognized basis percentage of completion. Now, there is an interplay in this because for real estate players, you do not have a specific ICDS which is notified for builder developers, which is still under progress. So once it is notified, there'll be a different ICDS to it, but do not mistake the construction contract section, or I would say this ICDS with the builder developer accounting. So you will have to keep that in mind while you are reporting. In revenue recognition, for sale of goods, significant risk and rewards of ownership are transferred and there is reasonable certainty of ultimate collection. This is similar. Ind AS 115 definitely gives a different picture to it. But if the basic broad principles remain the same, I don't think there is a challenge in any revenue recognition in that case. Revenue recognition from service transaction is again percentage completion method or straight line method. This is in sync with Ind AS 115 because Ind AS 115 does not specifically give you any criteria on how you're supposed to recognize revenue. But yes, they give you an overtime and point in time completion. Once followed completely, you can have that in place, which is the case for these sections as well. AS 9 is neutral and we do not have any impact in terms of this. ICDS 5, which is on tangible fixed assets, like I mentioned, that those disclosure requirements are more similar to clause 18. So a suitable note incorporating that the disclosure requirements in terms of ICDS 5 are more similar to clause 18 also would suffice, and you need not give a replica of that disclosure again back in this reporting. Then there is ICDS 6 and ICDS 8, where there are no disclosure requirements. ICDS 7, which is on government grants, this is mainly for entities where you have government grants. There you need to disclose the nature and extent of the government grants recognized and not recognized. For ICDS 9 borrowing cost, there's a disclosure requirement for the accounting policy to be followed, but while we see the interplay between accounting standard as well as the ICDS, I do not see a major difference. In the earlier years, there was a different formula driven sheet which was there, like 14A disclosure that we do, which is now being understood by the assessing officer, and there have been a lot of discussions as well as case laws over it. So hence, this differential recognition in terms of borrowing costs for books as well as income tax has been done away with. While some SSCs still face this, considering their policy is different or which is required to be done as per the ICDS, there you need to specifically disclose. ICDS 10 is provision, contingencies, and contingent assets. This again is similar to what we do as disclosure requirement in our financial statements. So we can probably refer to the financial statements when it comes to this. There's a technical guide which has been issued by ICAI on the same. You can probably refer this to have a much better impact, a much better assessment of how you want to disclose things in your tax audit report. Moving to the next clause, which is clause 14. Again, I've taken this clause only in terms of manufacturing entities, because obviously manufacturing entities will have a closing and an opening stock. NBFC would usually not have so. To be very clear here, that section 145A is nothing but it tells you to do an inclusive as well as exclusive method on the impacts of taxation on the opening and the closing stock of accounting, and if there is any impact on the profit and loss thereof. I would say in the earlier places, there were a lot of disputes that AS2 and Ind AS 2 is specifically asking us to exclude taxes and account for, whereas 145A is saying, but there is actually 145A is usually tax neutral. I can explain that through an example that I've put here. Majorly, the reporting that is required for this section is specifically based on the deviation, if there is any. So if there is any impact on the profit and loss, then you need to specifically disclose, which in usual cases, considering a lot of now assessees have now system-driven reports as well as system-driven accounting being done, I don't feel that there is a tax which would impact. So a profitability which could impact, and now it will become tax neutral because the profit which is reported in terms of excluding GST or excluding any taxes and inclusive of taxes is usually the same. I'll explain it through this example. So say you have an opening stock which has a rate of 10 and a quantity of 10 and which has a GST of 2. Similarly, raw material purchase, other manufacturing cost, finished goods manufactured, sale of finished goods at 25, the GST rate is 3, and say my net quantity which is sold is 60. My closing stock for raw material is 20 and closing stock for finished goods is 20. I'll just quickly explain in both the methods, which is exclusive or inclusive method, the impact on your PNL is the same. So in the first case, your opening stock is 100, which is 10 into 10, which is excluding all the taxes. Sales is 25 into 60, which is 1,500. Closing stock is 20 into 20, which is 400. Raw material purchase is 90 into 10, which is nothing but 900. So you have a total cost of 1,000 less your closing stock of 200. So you closing stock of raw material specifically. So now you have raw material consumed of 800. So this is your cost, or I would say raw material cost. And then you have a total manufacturing cost of 800. So now you have a total cost of 1,600, which has been expensed out in your PNL. And you have a total of credits of 1,900. So you have a profit of 300. Similarly, when you go to inclusive method, where you will be including all taxes, which is 2, 2, 3, 3, 2, 3. If I just give you an example here, so say 12 into 10 is 120 that we are considering as opening stock. And similarly for sale of finished goods, we are considering 60 into 28, which is nothing but 1680. In both these cases, you will see that your total cost has increased, and definitely because you get an you get an input tax credit on this. There's nothing but a ITC or SENVAT credit on raw material that you get. So your net raw material consumed remains the same. Your manufacturing cost remains the same, and nothing but your 460, which is the closing stock, you get a specific excise duty on same, which has been excluded. So after that, your net profit definitely remains the same. The next clause is, just a minute. Okay, I'll just share my screen again. I'm so sorry. Yeah. So the next clause is clause 17. I hope everyone can see my screen. Fine, I'll just go ahead. The clause 17 is specific. I have got this section only specifically because there's a lot of rulings, a lot of disputes going around. One of that was earlier, it was that you cannot. I hope everyone is aware about the section. I'll still repeat the section requirement. So 43 CA is nothing but if any land or building is sold, I would say 43 CA or 50 C, a land or building is sold or transferred at a rate which is lesser than the stamp duty value, I would say available. If it is lower than that, you have to have taxed on the value which is at the stamp duty value. Now, there has been a tolerance limit, which was 5 earlier, which has now been increased to 10. So say now, what we say is that say your asset which is sold or an immobile property, which is land or building, which is sold at a rate which is 110% lower than 110% of the value, then you will have a tax which will be attracted towards it, because it is said that it usually this was done for eradicating or having a stamp duty implications, but now considering this section has been brought in from a very long time, this is mainly evading all the transactions which are done below the stamp duty value. So to bring a lot of alignment in terms of revenue or the rates in a specific region. Now I'll just give you a specific instance or an issue which comes up is, say there's a specific area which is restricted from development because of some restrictions. So say you have an area which is nearer to the airport colony. You cannot have any other new high-rise towers being built there. But the recent sale that is happening for those premises, the value is obviously lower because those are old premises. So when there is a sale which is done because and the area rate that has been derived basically in this, I wanted to highlight that the area rate that has been derived is basically considering a specific area amount that or an it's derived basis a specific area, whereas a specific part of outside the dominance, so there will be obviously a sale lower than this. To give you one more example, say you have area such as Worli, which is one side is completely covered by beautiful sea and the ocean, and the other side is completely based on the mills and everything. The rate for different areas would be different, but the stamp duty value which has been derived is derived as common. So there could be rates which are lower than that, and a lot of your SSEs would have issues in terms of showing or taxing those revenues. And then there are, if you can see, there are case laws running towards it. One of those is Surendra S. Gupta, which has allowed higher than specified tolerance limit because they were evaluating the tax liability. So in those cases, he was allowed a higher tax because of certain facts of the cases. So your SSEs may have restrictions in taxing those, but as an auditor, we will have to ensure that all these disclosures are done properly, and suitable notes, if required, needs to be updated in terms of tax audit when we are filing it. The next is clause 18, which is on depreciation, which is allowed. I will just touch upon briefly. I'm just touching upon this clause only from the purpose of the requirements that it has. And there are certain issues which we may be discussing. So there is the conditions which is required for claiming depreciation under Section 32 of the Income Tax Act says that the assessee must be the owner of the asset. It's not necessary he's a registered owner. It should be for the purpose of business or profession and should be used during the previous year. Now, used could be active use or passive use also. And use of this individual asset, which is nothing but the put to use, it has to be examined only in the first year when it is purchased. Subsequent years, it is forming part of the block because it is a block of asset concept. Now, Section 32 also gives these following assets which are not entitled for depreciation, which is freehold land, livestock, imported cars, expenditure, which is for research and development, assets which are not owned. These are the summary of audit procedures I think everyone is aware of, which is already being highlighted in the guidance note as well. Just 2 or 3 things I would like to highlight, because there is a detailed disclosure requirement in terms of the reporting. So I'm just highlighting, which is the classification of asset, but classification from the point of view of a block, and also the rate of depreciation which is being charged. So if you are not classifying it correctly, then the rate that you are applying is also not correct. So as an auditor, we need to please ensure that the classification of an asset is done correctly and it fits into a proper block of asset. The next is the addition and deletions, because you need to have a separate reporting done over it, along with the SENVAT credit, which is deducted from the cost of. So you need to have a SENVAT credit amount reported separately on these assets as well. So additions and deductions along with the dates needs to be maintained and has to be recorded. In this, you will have 2 issues, because for additions, when you see date of acquisition, put to use date is something which is very important. How do you assess a put to use date? Like earlier, in the earlier slide, like it is explained that it is active or passive use. How as an auditor would you justify that this is put to use? So in most of the cases where we see where it is not justifiable that the asset is put to use at this specific date, we usually take a confirmation, or I would say a confirmation separate letter, not an MRL, not forming part of your MRL, but a separate letter or a certificate from the client justifying why it is put to use on this date and for what purpose. So these are specific issues, or I would say specific questions that usually come up. I have just tried and put some of those here. So whether depreciation is allowable when plant is in use or no. Like I said, condition of use is only relevant in the year of which the asset is purchased. After that, it is forming a part of the block. So if it is passively used also or even closed also, it doesn't matter. Depreciation will continue on that. Then whether depreciation is allowable for SSEs whose income is fully exempt. So no, because it will lead to double exemption. So if you are completely exempt from paying any tax, you cannot have a specific deduction in terms of depreciation. So then whether the tax auditor can include SENVAT credit claimed but disallowed in the actual cost of asset. This can be done, but you have to be sure that when you are claiming a SENVAT credit, it has to be actually disallowed in the cost of asset. So please take care of that. Then how is the depreciation calculated when the asset is used partly for business and profession? This is purely on proportionate basis, and which is already enhanced, I would say, specifically mentioned or illustrated in section 38(2). Clause 20, which is nothing but employee contribution of funds. I have just put this here from the specific section because the section 36(1)(5)(a) and 43(b) were amended by Finance Act 21, which is nothing but 2 years before. But still we need to understand this because a lot of assessees still do not understand contributions to be put under employee contribution funds. Because if I just give you an example, what about labor welfare fund? Do we need to add? It has been specifically mentioned that any contribution which has been received from the employee by the employer needs to be specifically paid in terms of the due dates mentioned, and that has to be reported here. So that is why contribution to be disallowed even if deposited late, but before the due date of filing of return of income, will also result in permanent disallowance. And there's this one case law, Gopalakrishna Ashwini Kumar versus ADIT, which is saying that this amendment, what has been done, is prospective in nature and not retrospective in nature, to avoid all the other repercussions to it. The audit procedures for the same is, like I said, all contributions which have been received from the employee and have been deposited needs to be noted by the auditor. You need to have the due dates readily available. So in some cases where you have, say, multiple factories at multiple locations, you will have specific due dates as well. A simple example, if I give you, is PT, which is profession tax, which is also a subject matter of deliberation, that whether PT amount which is recovered should be disclosed here or no. It is usually said that whatever amount is recovered from employees has to be disclosed. So PT also needs to be disclosed. Though it is a state-driven tax and not a center-driven tax, you still need to disclose PT, and there you will have different due dates for different states. So you need to take care of that. So that's why the due date of payments and the actual dates of payments also needs to be verified by us, and we need to have evidence of the same in our documents. Also, where employers have not deducted or collected any PF or any other dues, you need not mention that in the form. Next is clause 26, which is nothing but liabilities which is allowed on payment basis, which is nothing but if you have any liability in your books, you will be allowed for deduction only when you pay it before the due date. One specific thing to be noted is that what are these liabilities? So section 43(b) is mentioning those specific liabilities, which are nothing but taxes, duties, cess or fees, contribution to welfare of employee, which is PF, superannuation or gratuity, which is made by the employer. Employee deductions have already been covered under 20. Here you will mention only employer because they are making any contribution to the welfare of the employee. Bonus or commission payable, interest on any loan or borrowing from specific institution. Now, the specific institution is also given in a proper explanation in our guidance note. You can probably refer that as well. In lieu of leave payable and as well as payable to Indian Railways. All these deductions are not to be considered from, all these expenses are not to be considered from an accrual concept, but will be allowed only on payment basis. So going back, provision for leave encashment, again for leave encashment, which is payable to employees. There was a specific case, a very famous case of Union of India versus Exide Industries Limited, where this data becomes very voluminous because every year your leave encashment keeps increasing and your payment is only on the date, which is always a mismatch when the employee leaves. So you have an accumulated leave balance or a leave encashment payable to an employee of, say, specific time, but the payment or the amount that you are being actually taxing, or I would say claiming as a deduction, will always have to have a reconciliation in place. In this case, it was made very clear that leave encashment will have to be maintained from a reconciliation angle, and it will be only deductible on payment basis. There is no exception to this. During COVID, a specific relief was being granted, which I think in most of the cases now, because all of the loans have come out of the moratorium period, I don't think this would be impacting so much. But yes, it was specifically covered that if any interest which has been actually paid and any interest which is referred to in this clause, which is converted to a loan, will actually be will not be deemed to have been actually paid. So basically, only what is paid actually as interest will be deducted. But say you have any interest which was accrued in your books and which is converted into a loan, which will not be deemed to have been actually paid. Moving to the audit procedure, here what we do is whatever disallowances, or I would say whatever carry forward balances you have of previous year, that you will carry forward, bring it forward here, which is your opening. Then you need to see whether any payment which is made after 31st March of the previous year for any pre-existing liability is not claimed as a deduction. So that you need to have a proper documented evidences, which is nothing but 26A and 26B that you already have. So you bring all those balances and then you check that there's no such specific payment which is made after 31st March of the previous year. Then you need to check whether there is any payment made under protest or any advance payment being made. If that is the case, whether it is being allowed and are we including the same in the reporting. You need to properly have a scrutinizing your ledgers and liabilities, which will have all these expenses covered, specifically 43B expenses, and accordingly see whether it has been paid. All documentary evidence in terms of the payment, which is nothing but either challan copy or acknowledgement copy or a bank statement copy, needs to be documented properly. Moving to clause 31, which is nothing but 269 SS and 269 T. So this clause specifically is bought into to tap a lot of cash transactions. Cash, or I would say other than account pay check or bank draft. So which is nothing but indirectly now it covers a lot of electronic transactions also, but it is mainly there to tap any cash transactions. So 31A and B this is nothing but just a summary for your reference. 31A and B is details of each loan or deposit and details of any specified sum. This is nothing but any amount which is taken or accepted exceeding 20,000, which is nothing but other than account pay check, bank draft or ECS, then you need to be reporting amounts here. 31BA and BB. So here you need to report all amounts which is exceeding 20,000, but obviously you need to report as disclosure whether this is by account pay check, bank draft, etc. 31BA, BB is nothing but each receipt in an amount exceeding the limit specified, which is 2 lakhs. So 2 lakhs if you receive from a person from a single transaction and or a transaction relating to a specific event, that also in cash you need to report this specifically. 31BC and BD is nothing but this in 31BA BB we saw receipt, here we are saying payment. 31C similar to 31A and B, where we are saying particulars of each repayment, which is 269T, not 269SF. Now this is 269T. Section 269T specifically mentions about repayment of loans and deposits or specified advance taken by the SSC, which is exceeding 20,000 rupees. This is again a disclosure requirement where you will have to disclose these amounts and you have to mention whether they are through check, bank draft or ECS. 31D and E is again specific repayments made, which is amount exceeding the limit under 269T, which is 20,000, which is received during the previous year. This is specifically received during the previous year. So if you've received something and you've made repayments of that in the same year itself, you need to report it here. So whether such repayment received otherwise by, again, you need to report that whether it is by account other than account pay check or bank draft or ACS. Now, a specific question, the transaction by journal entry, whether it will be covered. So there's a specific case law, which is CIT versus Triumph International Finance, where it says that a loan or deposit which has been repaid merely by debiting through an journal entry, and it must be held that the SEC has contravened the provision of section 269T. Because it is netted off, or I would say it is just a accounting entry, doesn't absolve you from not reporting this. So you need to keep reporting these transactions as well. Now, specified sum in 31A, when we discussed, we had something called as specified sum. Now, specified sum, which is accepted or repaid during the year, has been described in the Act as any money in relation to transfer of immovable property. So say you have received any money or paid any money in terms of transfer of immovable property, and transfer of immovable property clearly states in any form or kind. So basically, say you hold an immovable property in terms of inventory, mainly because of real estate builders. So there also it is covered. It doesn't absolve us from not reporting under those. So it has now become a cumbersome reporting for a large real estate players, where they will have to have all sale or transfers made of immovable property, which is nothing but sale of residential premises. If they have received any money about 20,000, which is obviously going to be the case, they will need to report all those transactions separately. Clause 34, which is TDS and TCS reporting. The clause, when it had come as a first time reporting, was obviously there was a too much of hue and cry around this clause. Now a lot of assessees have had their systems in place to try and reconcile these balances. But as an auditor, we always dread when it comes to taking ownership of this because of the voluminous data. And that's why there's always a note in the tax audit, which we usually put, of our limitation in checking considering the voluminous nature of data. So that will obviously be there, but not to forget what all simpler things we could check to avoid any non-compliance, and wherever we see any non-compliance. So this is one thing that as an auditor or as a tax auditor, you need to be very careful on, is wherever you notice even a single transaction which has not been deducted or deposited on time, say deducted on time but not deposited on time, or not even deducted on time, you need to have that reporting under clause 21B1 and 2, which is nothing but for one, it is for non-resident, payable to non-resident, you will have 100% disallowance of the entire sum which is payable, and entire sum which is payable to the resident, 30% of the expenditure will be disallowed. So this is in relation to non-deducting or deducting on time but failing to deposit on time. Along with that, don't forget, whenever you're making a payment, your interest of 1 or 1.5% in each case would definitely be there. And you need to make payments taking into consideration these interests. There's a penalty clause, which is under 271C, which specifically says that a penalty of an amount equal to tax not deducted or paid also could be imposed. This could be done discretionary to the TDS officers. Now here, what is important is two things. You need to have a reconciliation of your profit and loss with the expenses that are eligible for TDS deductions. Now, usually companies find it difficult to reconcile, but I would say there are certain audit procedures which is equally available, or I would say specifically or very clearly explained in the guidance note, which helps us to form an opinion on this. And then that's where, if you have substantial evidence and it is easier for you to have all records in place where you can justify or reconcile all the expenses and on which the TDS has been deducted specifically, and you can correlate that with the TDS returns being filed, I think it is advisable to still give a note in the financials. Or if you have no documents available or there is difficulty in obtaining requisite documents to your satisfaction, I think you should qualify the same in the tax audit report. That option, or I would say that clarity, has been given in the tax audit guidance note by the ICAI. TCS also gets covered with effect from 1st October 2020, and I think all of us have now been started reporting the same. The procedures, I have just summarized the procedures for ease, which is for 34A, you need to have the figures matched with your returns, which is filled in column 5, 6, 7, 8, and 9, along with the workings that the client provides. So those workings which the clients are providing has to match with the returns. You need to check the rates of TDS. So only checking it with the returns will not absolve you from your duty of doing your reporting. There are 2 or 3 other things that you definitely need to do. One is you need to check the TDS rates. Wherever the TDS rates are different or say lower, or there is no deduction being done, you need to either have a discussion with the management or obtain lower or nil TDS deduction certificates from them. Basis that only you can say that TDS had to be deducted at say 10% but has been deducted at 2% is basis the lower deduction certificate, or no TDS has been deducted on the same because there is a 0% deduction certificate available with us. We need to have these checks in place, documents in place, and we need to apply it correctly for rates which are applicable to individual HUF as well as companies. Along with that, also need to see the exemption limits wherever the TDS exemption amount is available. So please check everything in detail when you're documenting it. Apart from that, there are 2 additional checks which have been enunciated in our tax audit guidance note, which is nothing but a default summary needs to be checked, because now you have a default details available on the portal. So you can ask the client to give you a default summary screenshot, and if there is no default occurring or reflecting in any of the quarters, then you can take that into cognizance and accordingly report. Along with that, if there is any default, if you can see any default specifically mentioned, then you need to obtain a justification report. Other than this, it is advisable to have the conso file, or I would say the consolidated file, which the client fills for the returns that they file, to make it more easier and to match it with the returns that is filed. It is very difficult to obtain these details considering it is usually sensitive or confidential to the entity. But in terms of tax auditor, you definitely have authority to verify each and every detail when it comes to TDS and TCS being deducted on time or not. So I think we can have a discussion with the management and get those details in place. For 34B, only acknowledgements for returns is enough. The due dates needs to be seen. You need to have reporting done basis the revised returns that have been filed to avoid any discrepancy between the TDS records as well as the income tax records that we are filling. So that is more important. For 34C, which is specifically in relation to delay of payment or TDS or TCS, if we have already observed and we've seen whether any interest on TDS has been paid, you know that this clause will definitely be applicable. And accordingly, you have to check whether under which section, which is 2011A or 2067, you have to see whether payments has been made and appropriately record. This will obviously be there in your financial statements in a specific ledger, or in a ledger specifically mentioning interest on delayed payment. It could be there. You can probably verify ledgers of the company and see whether this has been reported correctly or no. Also, the challan of the payment that you're making with delayed payment will obviously have an interest amount mentioned separately. So you can probably check it from there as well. So few questions over this. So on which amount the TDS is to be deducted? It is inclusive or exclusive of GST? I think now this is clear to everyone that this is exclusive of GST. Should TDS be deducted on amount exceeding the threshold limit or the entire amount? I think the full amount. Once it exceeds the threshold limit, it is on the full amount. Then if initial payments are made and no TDS is deducted, say the value of contract is estimated to be less than the threshold limit, but subsequently the value exceeds the threshold limit, would any penalty or interest be leviable? So it says that no interest or penalty, as there is no default of non-deduction or payment at any point. So this also needs to be taken into consideration. Under clause 34C, should the amount of interest payable on 31st March and paid during the current year be reported, or report all interest even if paid in the previous year itself. So here it specifically says only amount of interest paid during the previous year needs to be reported, not all interest. Something which you have reported as payable is actually to be reported, but only if in the previous year. Then under clause 34A, in case TCS reporting, total amount of receipt is to be reported including TCS or excluding TCS. It says excluding TCS because that's how you will come up to an amount which you will be recording in your financial statements. The last clause that I'm covering is clause 44, which is on breakup of total expenditure under GST. Now, again, this being a new clause has become very important in terms of reporting. This is the reporting disclosure requirement is there under the tax audit form. I would just say a lot of companies now have systems in place. Earlier, systems were not in place, but now we have systems in place to have these checks and balances made in place. So I have just quickly given two small procedures around this. If we can achieve only this much, I think we are able to sail through. If we are not able to achieve a lot of these details from the client, definitely we need to probe more into or either qualify the tax audit report. So the tax auditor will have to have a control sheet. This is nothing but an internal control sheet that we can have, or we can ask the client to prepare this for us, which will have the total value of expenditure in the P&L. Now, because the column 2 that we are reporting here is nothing but total amount of expenditure incurred during the year, will obviously have GST expenditure, which is not forming part of an expense in my books today, because it could be of capital nature, or any other capital asset which was sold earlier, which was purchased earlier, which is sold now. The profit comes to PNL, but not the total amount. But your GST would be on the total amount. So there are certain discrepancies. To go away with it, we have this control sheet, which is nothing but total value of expenditure in PNL, which is nothing but debited to the PNL. Then you have total value capital expenditure, which is not included in the PNL for the year. So that you will add back. You will reduce the total value of non-cash charges considered as expenditure. So if there is anything such as depreciation, such as any other non-cash debits that you have made, you will exclude that because that does not have any impact on your actual cash flow. The next is the total value of expenditure excluded from being transactions in securities and transactions in money. So this is nothing but again in nature of non-cash, but because these are specific transactions which are excluded from the purview of GST, we are excluding this separately. And the last is total value of expenditure excluded by virtue of Schedule 3 to the CGST Act. So any other expenditure which is excluded, you exclude that. Whatever you get is nothing but value of expenditure, which you will report under clause 2. Now, details of all these deductions, additions, what you're doing will have to be either GST wise, because if say you have 5 different factories at different places and different GSTs in place, you will have to have this working for 5 different things. Or if your PNL is, I think, reported together, you can have a summary in a columnar form and accordingly see the total and reconcile it with your total balance, total PNL debit. Now, the details that needs to be furnished here, if there is a specific report, or we can ask the client to give us these specific details through their GSTR 1 and GSTR 3B that they are filing. It's easier to get this details from them in terms of the expenditure head. So in which what expenditure has been made and what head does it fall, the name of the entity to whom the payment is made, the GST of that entity, the value debited to the expenditure account, then the value for which input tax credit is taken, then the total amount which is paid to the vendor. And if there is nil GST, reason for that, and general remarks. If you have a detailed document or a detailed working paper in terms of this, I think reporting for this will become easier, because I'll tell you how. So name of the entity to which it is paid, and say nil GST. Now say supposing some vendor is not registered, so hence you do not have GST which is charged to you. So you're not paying any GST. So the amount of expenditure debited, credit is not there. So you have directly an amount which is paid to the vendor. If it is done on inclusive basis, definitely yes. But if there is no GST, you know it's a unregistered dealer, and accordingly you can have those details excluded from here and reported here, that those are the entities which are not registered under GST. So that's how the entire description has to go. These two documents usually will help us to get a comfort. If there are other ways, so if your assessee has a specific system in place, because I have personally seen that there are assessees who have suitable documents in place. These documents in a format in which they have given, or in the format in which it is extracted from the system, is sufficing to report the requirements correctly, and which is in sync with the GST returns that have been filed. You can take comfort on that and accordingly take your reporting requirements in place. I am open to questions and answers. Thank you, everyone. Sugandha, are there any questions from everyone? I think we have around 2 minutes to.
Yes, yes, Priya. Before that, I want to express our thanks to you for your detailed and insightful session, and your expertise has been invaluable, and we truly appreciate your contribution. And moving on to Q&A session, there are a couple of questions which we have right now. So the first one is there any direct correlation of tax audit with any other authority from income tax, apart from income tax?
Okay. So I think, like I said earlier, that now a lot of things are now getting digitized, and the income tax department is not the only one who is viewing our documents. So you have Aadhaar and PAN linked together. You have your bank accounts already being linked to your income tax returns that you are already giving. So it usually gives you that these are so your AIS statement is there, which gives you that these are the bank accounts which are there. Do you need to add that in your return for filing or no? So I'm saying not only the income tax department is viewing your details, but say you have, so from the perspective of an assessee, we see that the GST department, the TDS department, the various other segments of the aspects of the government are usually trying and correlating a lot of information that we have. And that's one reason why we have the AI statement in place. So the income tax will have a wholesome role and a wholesome view of whatever transactions are being reported at different places. And not only our details are being used when we are submitting it to the income tax department, it is obviously being used by the GST and the TDS departments as well to correlate information. Because now if you see the tax audit report that we are filing has a detailed reconciliation done to GST. Obviously, this report is of no relevance to the income tax authority, only in terms of what indirect tax they are paying. Only the thought that they will have is what tax is being paid under indirect taxes. But this information is most relevant to the GST department. So it will definitely be linked at some point or the other. And I think government is on a spree to get all these things linked and digitized so that there is no way left out from being non-compliant in any of the cases.
Right. Thank you. So the next question is on how many tax audit reports can a chartered accountant sign?
Okay, so I had mentioned it in my earlier this thing. You can have, so one chartered accountant can sign 60 tax audits. That is per person limit, which is available as per the ICI framework also and as per the requirements of tax audit also.
Okay. Next question, which has just come in, is a private limited company having turnover of rupees 17 lakhs and has a loss of about 2 lakhs. Is tax audit required?
So requirement of tax audit is specifically on a turnover, say it's a business or a profession. If you see a profession, it is 50 lakhs, and for a business, it is 1 crore. In similar case, if you have cash transactions, again, you will have to take care. If you have cash payments or cash receipts more than 5%. So giving you an example in this case, say you have a turnover of 17 lakhs, but your, I think this is not applicable because the broad limit is 1 crore and 50 lakhs. So mostly this is not applicable if it is 17 lakhs only. If it exceeds 50 lakhs or exceeds 1 crore and say up to 10 crores it is there, you still have that leeway, whether if your cash transactions are less than 5%, you can get away with it.
Okay. So because of paucity of time, I just want to ask one last question,
Sure.
which is that in the situation of multiple businesses, how do you calculate the sales turnover?
Okay. I think very nice question, and this is something which we keep deliberating on. So, like I said, turnover will be viewed as gross receipts. So now in this, if you see overall business when you are seeing and you see that it is more than a specific amount that is obviously there, you bifurcate it into different heads. But overall picture, it will be applicable if it is more than 1 crore or 50 lakhs. So it definitely will be applicable. Reporting under tax audit could be division wise, and accordingly you can take reporting cognizance. But yes, on a total gross receipt level, if it is taxable, you need to have tax audit being done.
Okay. Once again, thank you, CA Priya. And I'll hand it over to the next speaker now, CA Bansari Sethia, to take it forward. Thank you.
Thank you so much. Thank you, everyone.
Hi, good evening, everyone. I am here to give a brief introduction to our next speaker, CA Kamini Meherwal. CA Kamini Meherwal is a former chairperson of the Ujjain branch of the CIRC. She's a qualified chartered accountant and a company secretary. She also holds a certification course in component audit, forensic audit, and a DSAP from the ICAI. Currently, CA Kamini Meherwal is working as a partner with Messrs. BK Ladha and Associates. She is also an assistant professor with the Government Degree College at Shajapur, Ujjain, Mahidpur, and Sambir. And she is also a visiting faculty at the Mahakal Institution of Technology and Maharaja College, Ujjain. We welcome you, ma'am, to throw light upon the issues that women have been facing in their professional life. Over to you, ma'am. Hello. Hello.
Hello, I am
Hello.
audible.
Yeah, Priya, we can hear you. I just gave a brief introduction for CA Kamini Meherwal. I'm not sure whether I think ma'am's on mute.
I am audible.
Yes, yes,
Hello.
Priya. Yes, we
Hello,
can
I
hear
am
you.
audible.
We can hear you.
Hello.
We can hear you, ma'am.
Yes, ma'am, you are.
I am audible. Okay. I am start my presentation with blessing of Baba Mahankal and Goddess Ma Saraswati. I Kamini Ravi Medwal from Ujjain city of Baba Mahankaleshwar. First, I am thankful to Women and Young Member Excellence Committee, respected CA Preeti ma'am, respected Vice Chairman CA Abhay Chajarji, today's speaker CA Priya Vora ma'am, and all young energetic coordinator give me this opportunity. First, when we start work balance life, balance is not a better time management, but better boundary management. Balance means making choices and enjoying those your choices. Work-life balance. Work-life balance, we can define here, work-life balance is a combination of the profession and your personal life. When we talk about our profession, so our profession give us name and fame, and after all money. As when we talking about our personal life, so our personal life, healthy, happy family. Thus, it is clear that profession and personal life both is important for us. When we are talking about, especially in the difference of the CA woman, the women are playing a vital role in their life to manage their dual responsibility. This expression work-life balance was first used in the United Kingdom in the last 1970 to describe the balance between an individual work and personal life. So, if you want to maintain work-life balance, it is important that decide to your priorities. What is the priorities? Priorities is always differ to person and day to day. So first, you have lot of work throughout the day, but you can make to-do list. But you can make as one, you set priority according to their importance and complete them. Here we are talking about the CA woman. Then work balance is a key part of women CA. For healthy and productive work environment, women who achieve this balance successfully dedicated required amount of time as per priorities to work-related tasks and personal matter without expressing any stress level. This means stress level we minimize. Now we come to our main point. Why work-life balance is important? So we have given here the 9 points. It is not only point, it is a chain of importance. Our 3 points, maintaining mental health, improving physical health, and minimize stress. It is the most important point in our life. This is chain of importance. Please we understand step by step our practical life. It is accepted to my 18 years of practice in this field, 11 years of my academic career. Means when we will mentally strong, then first you will be mentally strong. That means our emotion in our control, our physical and social side will in our control. Naturally, we improve our physical health. That means maintaining mental health and physical health. Both are correlated. When we maintaining our mental health, so naturally improving the physical health automatically. And the both point is correlated to minimize our stress level. First question in our mind, there's one question in our mind, can stress be eliminated? So naturally, our answer is no. We cannot eliminate stress, but we will success to minimize stress in physically. Both are the fit. That means our 3 points, maintaining mental health, improving physical health, and minimize stress is correlated. That means this is a chain. So first, our mental health is must, because our mental health control our emotions. And when we control our emotion, our irritations, our other disorder is a better, and we are control easily. Same thing, we are improving our physical health and then minimize our stress level. And with 3 level is put up in our increased productivity. What is the productivity? Productivity means better output from the same amount of input. When we have introducing 2 hours, but our output is more. When we are mental, physical, both side is healthy and minimize our stress level. So increasing our productivity. We will become best in our field. Everyone have been support you. When your productivity is increased, you are the hero in your field. When our productivity increase, the next impact, increase creative thinking. What is creative thinking? When our productivity increase, naturally we will become a team leader as a creative thinking, new ideas, new innovations, new concept, new vision, new planning. And everyone, we are together by creative thinking. That means most important point is a creative thinking. Okay, we are not alone. All one is our group, all one is a team, all one is a working as a together, and we are being strongly being successful. So when we are successful, success is a new thing. I always remember my result of CA. The success is reflection on your face. Success is always reflected in your body language. Success is always reflected in your all the activities. Will you become happy and fulfillment? That means if you increasing creativity, increasing productivity, that become your success. Successful is our turning point. We focus this point. How successful is a turning point? So then maybe we will success, we will reflect in our life from happiness and fulfillment, overall improve your relationship. Relationship in all the way. As your children, as your better half, as your client, as your other all relatives. That means improve your relationships as a next chain. And when we 1 to 8 point correlated to each other, and after all the point related to manage your responsibility. Most important point is our responsibility easily we handle. In the reference to women CA, but I think this vision is not only for women CA. If you want success in life, so no matter what is profession it is a business, politics, or to social work, you will be successful. You will get only you understand everything. Will take out time that when possible, if your life will be balanced and disciplined. Then here is most important word, discipline. That means when we are also priorities, also have a boundaries, already decided our working hours is we achieve enjoyment as per our work, as per our family, ourselves, and also our friends. When healthy work-life balance may be included. So how to become healthy as per our requirement? So first setting our boundary. Boundary is must for us. We are not decided any boundaries when we define work separate to our personal and working hours. So first decided your boundaries and separated to personal and work related activity. Next, important to time management. Time is a fix as 24 hours and our efficiency is limited. Our boundary is limited. Our priority is already set up. So efficiently organizing, prioritizing tasks ensures that you allocated enough work responsibility as well as personal pursuits, such as spending time with engaging in hobbies, pursuing personal goals. When we setting the boundaries, we setting the time management, then also most important to stress level management. When implementing strategies, manage stress level, such as practicing mindset, engaging in regular physical activity, taking break and unplugging from work activity when needed, and must as a flexibility, having to ability to adapt, adjust your schedule, accommodation, fund circumstances, personal needed without jeopardizing work community. That means a healthy work-life balance may be including these four most important points in your boundaries. When we are role of women here, simple we say, as a being daughter, as a being wife, as a being mother, our responsibilities are differ. Being a daughter, our responsibility. Being a wife, our dual responsibility. Being a mother, our unlimited responsibility. That means our child is always on the priorities. As a work woman, easily get the take. We would not prioritize our work family. Actually, why is not positive? We should also not engage in that manner. I feel proud that I'm able to my family first and then job on the second place. I do not feel like proving myself all the time. In the end, it's all about life. What we find importance leading successful life in general, we should define our criteria for work-life balance instead of being directed by society. When we are talking about being a daughter, the parents should provide all facility to their daughter for studying there belong as success in a chooses career. Choosing career, looking a successful red and woman in this field, it provides that give a chance. Girl can boom like anything. There is nothing which can stop here. It is a golden time of woman. That means this time is the best for all women. After marriage, when we independence get losing, she started getting directed by husband, in-laws. She chose to continue with her career. She has taken a dual responsibility her house as well as job. It's time of decision making with priorities. It is the most important point in our life and work-life balance. Please do not leave job. Practice switch as per your time and priorities. She being the mother of her child has the prime responsibility of her child. Moreover, CA office working hours are not flexible as per their choice. A CA is always seen to performing a marginal role, key person in the office, and has to be available even odd hours and holiday. You may encounter many defeats, but must not to be defeated. Now you understand the importance of work-life balance. It's time to start creating more balanced life for yourself. Chartered accountant is a profession nowadays grouped that offer more freedom that in other area of the regard to self-employment opportunity. As well, experience qualified CA can easily practice her accountancy as per her convenience. In education field, both college, personal training, institute women who have qualified as the most welcomed. How to improve your work-life balance? The 5 area focus. Manage your time, set limit, and learn to say no. Why? Because from the childhood, I may always say yes. So please learn to say no. Unplug when you leave work. Take all of your vacation time. Talk to others about your stress level and learn on your support system when you are especially stressed. Resolve to take better care of yourself. Get physical activity. Amount of sleep. This is the main slide of my presentation. This is really magic. And when understand this magic, really we solve this work-life balance in most easy way. Hello? Hello, am I audible? In a simple word. Sir, visible? Sir, visible my PPT? In a simple word, work-life balance is the magic of 8 plus 8 plus 8 hours. That means equal to 24 hours. But it should flexible. Not more than 1.5 hours as per your priority. Is important, not more than 1.5 hours. You may change as per your requirement, but 1.5 hours is the more than limit. This is a 1 hours, half hours as per your priorities. First, we understand this math. Example, your sleeping time is 8 hours. Plus, your personal life is 8 hours. Plus, your professional life is 8 hours. Equal to balance 24 hours. When you will work on this, easily manage work-life balance. So, first we understand for any example. Suppose our sleeping time is 8 hours. We already decided our sleeping time is 8 hours, 11 to 7. But many times I want to cut up this time. So 1.5 hour, that means our sleeping time reduced to 6.5 hours. So this means the 6.5 hour is the best sleeping. Your mentally health, your physically health, and for your stress level. If yes, your answer is yes. So you are cut up your sleeping time 1.5 hour, and 1.5 hour added to your practice 9.5 hours. But it is not easy to say. When our personal life it is 8 hour, can we reduce our personal life priorities? How many time is reduced? So 1.5 hour. Naturally 6 and 5 hours. So we set our priority as 6 and 5 hours, then 1.5 hours added in our practice. Then 3 hours is increased. That means we work is 11 hours. But as per rules, I think 11 hour is the hat trick for us, because our work is always stress level. We already say you, okay, we are not eliminated our stress level, because our stress level is always minimized as per our personal life or as per our professional life. So 8 plus 24 hours, your limited time. Thus, it is frankly say, okay, first you decide your boundaries. Okay, how to set this 8 plus 8, 24 hours as per manage our mental health and physical health, and minimize our stress level and increase our productivity. Then our creative mind become the success, and this all the point we give happiness and fulfillment, that our relationship is improved, and we work as well as personal and professional, both sides is equal, and our responsibility is fulfill it easily. In the end, I will say there should be a contact of light with karma. Karma is the most important word. When Hello, I am audible. Hello. Hello. In the end, I will say there should be a contact of life with karma and there should be verses of walking in the darkness. Please, any question?
Hello, ma'am.
Hello.
Yeah.
Are
Good
you
evening,
audible?
ma'am. Hello. Hello.
Good evening, ma'am.
Hello.
Madam, your voice is breaking.
Hello.
Hello, madam, your voice is breaking.
Hello, ma'am. Am I audible?
Yeah, ma'am.
Yeah. Thank you, ma'am. Thank you so much for this webinar. And yeah, I would be talking about the questions. The question is, what are the factors that should be considered while prioritizing the things for work-life balance?
Priorities is the most important. When we work any task, the first we decided our priorities. Many times, suppose in the occasion of festival, so our festival is the most important. That means our priorities. Many times the examination of our children, so our children is the most important. Then our first priority is our children's exam, and then our studied. Suppose the text study is the most important. That is first we decided every day and every person differ to differ. I am already saying our priorities always differ person to person and day to day. And in any life of our stage of any life.
Correct. Correct. And the second question would be, sometimes due to work pressure, there are different the stress level increases a lot. So what are the ways to manage stress?
Madam, simply, stress level is not eliminated. Stress level is always minimized by us. First, if we adjust our work balance, then means our mental health is a perfect, our physical health is a perfect. If perfect, so our stress level already reduced, ma'am. So first, we focus on our mental health, then physical health, and then we minimize our stress level and talking with our relatives, our friends, our colleagues, and our children's better up, and we reduce our stress level.
Okay, ma'am. Thank you so much. Thank you so much for your valuable time. No more questions for today. And the webinar was very informative. Thank you so much. There is a work-life balance problem in today's fast running life. So this webinar would definitely help us to take a step forward in balancing the work life. So thank you so much for your valuable time and thus informative webinar. Also, I would like to thank ICI for providing this platform on which we can discuss on various aspects. Yeah. Also, I would like to thank Preeti Savla ma'am, the chairperson, and Abhay Chhajed sir, the vice chairperson of Women and Young Members Excellence Team. So for providing the immense support always. They have been always there for any time, for any webinars, any support and everything. Now, I would also like to thank the committee members for arranging such informative webinars. These webinars are of immense support to all the members. And I would like to thank the technical support team. The technical support team, without them, such a smooth webinars would have not at all been possible. And lastly, I would thank all the viewer members for their active participation, thus making this webinar a success, and also encouraging us arrange more and more webinars in future. Thanks a lot, ma'am. Thanks, and thank you all the members, and have a nice day ahead.
Thanks, ma'am.